Good morning, one and all. Welcome to the Commodity Weekly audiocast with me, your host and guide Ravindra Rao from Kotak Securities Commodity Research Desk. As always, I'll guide you through the week gone by and will update you with the price action and events for the fresh week. As February ended, the main theme has remained to be inflation that remains sticky for major economies, prompting central banks to remain hawkish for longer than previously expected. Be it CPI, labor data, PCE, or retail sales, all pointed to a hotter US economy and the need to raise rates more. As a result, Fed officials maintained the hawkish stance and committed to higher rates. Money markets and interest rate futures are now expecting Fed funds terminal rate to rise to 5.5% by September 2023, which is 100 basis points above the current effective Fed funds rate. This is compared with the peak Fed funds rate at a rate of 4.9% seen during February 2023. At the same time, expectations of rate cuts have also come down, with traders now pricing in less than 15 basis point of rate cuts in 2023 from almost 60 basis points a month ago. US benchmark 10-year yields crossed the closely watched 4% levels, approaching November highs, while 2-year yields, a proxy for short-term rates, is hovering at around a 15-year high of 4.9%, taking some shine off commodities, especially non-yielding bullions. Dollar index closed the week with a 0.7% decline after four consecutive weeks of gains and closing the month of February on a positive note with gains of 2.7%, its first monthly increase in September 2022. The greenback hit a 7-week high of 105.35 during the previous week as favorable data releases from US coupled with reiteration of hawkish stance by several Fed officials further raised the prospects of higher interest rates in the US for longer. However, as tighter monetary policy for long will be a drag on the US economy, and that is why the dollar failed to sustain at higher levels. On the price action front, dollar index is facing resistance near 105.30 to 105.50 zone, which is the 252-day moving average on daily charts. So until that holds, US dollar index might trade in a consolidative mode between 103 to 105.30. Any close above 105.30 to 105.50 zone and sustenance above that might push it higher. Otherwise, we expect it to consolidate. This week, because of a lot of economic events, we might see either a breakout or a downside move in dollar index. Coming to precious metals, gold prices rebounded from an 8-week low of $18.10 per troy ounce, touched on 28 February, to end the week with gains of more than 2%. After notching a 9-month high of $1975.2 per troy ounce, the yellow metal has given up almost all 2023 gains as recent economic data from US raised the odds of higher rates for longer. Silver prices also rebounded to close the week with a 2.06% gain after six straight weeks of losses. Precious metals are holding steady, helped in part by weakness in the dollar index amid an unexpected rebound in Chinese factory activity as the nation ended its demand sapping zero COVID policy. On the investment demand front, SPDR gold ETFs have been in a continuous downtrend since April 2022 as the US central bank started aggressively raising interest rates to bring down the inflation. Prospects of higher rates might be a headwind in the short term. However, it might not be so soft on the US economy, which is expected to have a soft landing. On the price front, COMEX gold is taking support of the 252-day moving average near $18.10 an ounce. And until that holds a rebound till $18.58 is expected, which is close, which is very close now as uh, it is trading near 1858. So that is the resistance for this week. If it sustains above that on a few closing basis, we might see gold rebounding towards 1870, 1880 kind of a level, kind of a zone. In case of MCX, the support remains near 55,200, 55,300, and the resistance is placed near 56,200. So a break above 56,200 might push it further higher. In case of silver, support remains near support remains near $20.25, which is the 250 today moving average support. It made a low close to 20.50 last week, but then it rebounded very sharply. Resistance is near $21.55 dollars per ounce, which is the 52-day moving average resistance. If it sustains above that, we might see silver prices going higher towards 22.50, which is the next resistance. In case of MCX silver, support remains near 62,200, which is the 52-day moving average support, and resistance remains near 65,100, 65,200. Above that, we might see it going higher above 66,000. So supports need to be held by the bulls to take it further higher. Coming to energies, WTI and Brent crude oil prices managed to trade largely positive during the week and closed the week with 4.5% and 3.2% gains respectively, as Chinese demand optimism outweighed tighter US monetary policy concerns. On the price action front, WTI crude is close to the $80 mark, which is the immediate resistance, and above that, the resistance is placed near $82.50, which the bulls have failed multiple times to penetrate. And if this time it penetrates the $82 mark, we might see prices going higher towards $85 as well. So that remains a crucial resistance. And on the lower side, support remains near $76, $75 zone. In case of MCX crude, resistance is placed near 6,750. Above that, we might see fresh buying coming in crude prices, which might take prices higher towards 7,000 and above. On the flip side, support remains near 6,200, which might below which the prices might go lower towards 6,000 odd levels. So as of now, it looks a bit positive, but we need to see how the event unfolds this week, and that might give a trigger to crude oil prices. NYMEX natural gas closed the week with 23% gains and above $3 MMBTU for the first time since January 27. This was mainly because of colder weather projections and higher LNG exports. Price has jumped to 9-week high of 3.027 MMBTU as Maxus Weather Desk in its latest 6 to 10-day forecast featured colder changes to the temperature outlook for the southern lower 48 and also expects a wider spread colder than normal temperatures in the 11 to 15-day time frame. However, gas prices may remain volatile as US stocks remain high at a total 2.114 TCF or trillion cubic feet as of February 24th, up 27% from the year ago level of 1.66 TCF and 19% higher than the 5-year average of 1.7 TCF as per EIA estimates. So on the price action, it is just a rebound that is happening in natural gas, and we might see volatile action in natural gas prices. But as of now, the trend remains positive. As of this audio podcast, natural gas is trading lower today. It has opened the week with a sharp 10% fall. But it might take support at lower levels, and ultimately the bulls might target the 3.20 3.30 zone in case of the NYMEX natural gas. On the weekly chart, it has given a good piercing line formation, which has been confirmed, and the piercing line low pattern low is near $1.967. So until it goes below that, the pattern will hold. So any dips might attract buying in case of natural gas. In case of MCX natural gas, there is a bullish engulfing that has been formed on the weekly chart, which has been confirmed with the previous week's strong up move, and the next resistance is near 272, which the bulls might target. So dips might attract buying, but the pattern low of 163 would act as a support, so that should be the ultimate support, and below that the pattern might negate. Finally, coming to base metals saw a favorable turnaround in the previous week. However, the gains were trimmed in the last session of the week. MCX copper and zinc both ended with a gain of around 1% in the previous week. Stronger dollar weighed on the complex, while better than expected PMI figures and housing data from China fueled hopes of demand recovery from the world's biggest consumer. National Bureau of Statistics reported China's manufacturing purchasing managers index rose from 50.1 in January to 52.6 last month, highest since April 2012, while non-manufacturing goods increased to 56.3 from 54.4. Uh, on the price action front, copper might take support near 748 zone, 748 to 745 zone, which was the low hit in the previous week. And on the upside, the resistance remains near 770. So until 770 holds, the uh, price might stay consolidative between 745 to 770 775. In case of zinc, strong support is near 258. Until that holds, there is still a chance of a rebound. If that is penetrated, then we might see a sharp downside in prices. To conclude, price action might be volatile in this week, as U.S. labor data and Powell's testimony before the Congress will be in focus. Non-farm payrolls data will be closely watched to gauge more cues on Fed's March policy decisions. Well, with that, I come to an end to this week's commodity podcast. All the best and trade safe.